In this presentation, we will record the automobile into our personal QuickBooks file and the related depreciation, the related decline in value. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are on the home page. We currently have the open windows open. In order to open the open windows, we go to the View drop-down and select the Open Windows list. We're now going to go to the balance sheet up top by selecting the Reports, Company and Financial, then scrolling down to the Balance Sheet Standard. We'll then customize the reports up top. We're going to change the date range from 01/01/20 to 12/31/20. We're then going to go to, this is January through December, the year we're working on, 2020. We're then going to go to the fonts and numbers, make this a little bit larger by going to the change fonts. We'll then make it 11 and say OK, yes, and OK. Here's what we've got so far. We've been entering data from our bank statement into the register and then including some balance sheet items. Now we want to put the automobile on the books. We looked at last time a simple method for putting the automobile on the books. We're going to use a slightly more complex method this time, and it will give us a little bit more detail so you can analyze and think about the pros and cons of the slightly more complex method, which can give a little bit more detail and whether or not the more detail is worth the added time to put it in place. So here we have our information. We're going to say that as of the time we started to enter the data into the system, we remember our car was worth $14,000, but we bought it for $20,000. So we originally bought it for $20,000 way back when, before we started entering it into our system. Then we looked at the Blue Book value. We determined, okay, now it's worth $12,000. Well, what we can do then is put the automobile on the books at cost and then record the related difference in the form of depreciation so we can see both the cost and how much it's gone down in value. That can be helpful given the fact that the decrease in value is only an estimate. So we might want to know both numbers. So this time we're going to put the auto on the books for the $20,000, and then we'll show how to write it down with the use of accumulated depreciation, another account, and depreciation expense. So to do that, let's go back to our QuickBooks file. We're going to do a similar setup to start this up. And we're not dealing with cash, therefore we're going to set up a new account and then use the register for that account being automobiles. So we'll go to the lists drop down. We're going to go to the chart of accounts. We'll then go down to the accounts down below and use the drop up and go to the new account. We're going to set up a fixed asset type account for the car and then continue. We'll call that account just auto. This is auto. You can call it truck or automobile. Just make sure it's a fixed asset type account. We're not going to enter the beginning balance here because we want to determine what the other account will be that QuickBooks will put to it. And by doing this method, we'll be able to do so by saying save close. We then have our account. Now we're just going to double click on it to go to the register for that particular account for the auto account. Within the register, we're going to enter our balance. I'm going to enter it the day before the year that we started entering our input in, which is 12/31/19, December 31st, 2019. If we enter it at any date, that's okay as long as we use the equity account. It won't affect net income as we enter the data. We want to increase it, and we're going to increase it by the full value this time. The full value being $20,000. That's our cost. Now, we bought it way back when. So we're putting it on at cost even though we bought it a long time ago. So we're going to say, all right, we'll put it in at cost because I want to see what we actually paid for it. So we're in the increase side, $20,000. We didn't buy it on 12/31. This is just the date that we're going to start entering the data. We haven't entered any data into our personal account prior to that. It wouldn't make sense. It doesn't help to go back and enter data prior to that, in other words. So, and then the other side is just going to go to equity. So we'll select the drop down and we'll take it to equity, owner's equity. And we'll say okay. And we're going to post it to a retained earnings account. That's okay. If we go to our balance sheet then, what happened? We now have the auto went up by the $20,000 and the other side went into our equity. So our equity increases, like our net value increased by 20, and the auto went up by 20. Of course, that's too high at this point in time because one, the car's overvalued, and two, we financed part of it. So we financed 12,000 of it. So we got to deal with those two things. What are we going to do about the fact that the car we're saying now at this point in time is only worth 14,000, and then the loan we're going to say at this point in time is worth 6,000. We're going to deal with those two things separately. So first, we're going to say, okay, the car is now worth 14,000. How do we know that? Kelley Blue Book, we just kind of looked up what we believe the current value of the car is. We could depreciate every month as we would for like generally accepted accounting principles, but most people don't do that on their normal just accounting. They're probably just going to revalue the car from time to time, appraise it, and see what it will be worth by basically looking at the depreciated value, doing some research on it. So that's what we're going to assume people are doing here. Remember, this isn't generally accepted accounting principles for a company. We're just trying to put our books on the statements to make as good a decision making as we can. So we're going to say as of the end of December, we think the Kelley Blue Book is 14,000. So or the point that we're entering this in, the end of December or the January of the current year that we're going to be working in, we think that our value according to our research is 14,000. If we go back to QuickBooks then, we need to bring this down to 14,000. However, typically we like to see the original value and then the decline in value over time. So what we're going to do is record the original of the 20 and then the decline in value in another account called accumulated depreciation. Note that this is similar to the home where we had another account that recorded the increase in value. Now the home, from a generally accepted accounting standpoint, does depreciate as well, but we're hoping the value of the home actually goes up, and that's what we're recording here. We know that the value of the auto generally goes down unless we got some kind of classic auto. In order to record that decrease, we'll enter another new account again. So we're going to go to lists up top, we're going to go to chart of accounts, and then we're going to make a new account by going to, so we're not going to write it down to this account directly. We're going to have another account so that we can see the detail. We'll see what this does as we go. So we'll go to the accounts drop down. We'll go to new account. We want to make this as well a fixed asset type of account and continue. And then we're going to make this, I'm going to take the same starting auto, but then this is going to be accumulated depreciation. So it's a long word, but that's typically what we call it. Sometimes I abbreviate this to just ACC depreciation or just ACC DEPRE, ACC DPRE, if that's easier to look at. So then we're going to say save and close. And then we're going to go into that register. I'm going to go into that register. And then as of the 12/31/19, the end of the last day before the current time period we're working on. This one's a little bit tricky because it's a contra asset account to know if it's going to increase or decrease. So I think it's actually a decrease, and if it doesn't do what we think it should, we'll go back in here and adjust it. This is kind of the problem with ledgers versus debits and credits. They could get a little mixed up in terms of which is the increase and decrease depending on the type of account we're in. What we know then is that if we go back to our balance sheet, we put it on the books at 20. We currently think it's worth 14, so we have a $6,000 difference. And that's what's going to go here. So if we go back to our accumulated depreciation, we're going to decrease it, I think, 6,000. And then we got to record the other side somewhere. Traditionally, we would record the other side to an account called depreciation expense. So depreciation expense is what the other side is going to be. And we'll take a look at some other variations we can use, but we're going to start with the depreciation expense and say tab. This is going to be a new account that we'll set up. We're going to have it as an expense. I'm going to change it to an other expense. And that'll put it on the bottom since it's not cash related. And typically when we're dealing with expenses on a personal side, we kind of want to see the flows, the cash flows oftentimes. So I'm going to say save and close and enter that. Now if we go back to our balance sheet, then we have the 20,000, and then this account is related to it. And see how this gives us more detail. It tells us now, this is what I paid for the car, this is how much I think it went down by, and if I subtract the two out, 14,000 is what the blue book worth is as of the last time we looked it up. So that's going to give us a little bit more detail instead of just combining them into one account. So then we'll go to the other side, which is on the profit and loss, where we go to reports drop down, company and financial. Take a look at the profit and loss report. Dates 01/01/20 to 12/31/20. And then if we scroll down, actually we need to make this the last year because I entered this in the last year. So that's 19. And then if we go down, the depreciation is down here. We'll do this again for the current year as well, and then we'll look at a different way we can record this. Note that the fact is that its depreciation usually for businesses would be up in this area. I put it down below because, once again, we did it periodically. So that means we're probably not doing it monthly. We're probably doing this periodically. And so it's going to be a kind of a shocker to one particular month. And it might be better than to record it down here or maybe even straight to the equity section, which is another option we'll take a look at in a second. So let's do this one more time. Let's say let's say we looked at it at the end of February, and now we think the blue book is worth 10,000 at the end of February. So we're going to update it to 10,000. And so notice we're not doing a straight line method. I'm not doing any double declining like depreciation method. I'm going to do what people probably do on the personal side, look it up, what they think the value of their car is, and then write down the value of their car to what they looked up. So then we're going to go back over to our QuickBooks file, and we're going to go to the balance sheet, and we're going to say, now the car's on the books for 14, the 20 minus the 6. The 6 needs to go up by another 4,000 to bring it to 10, so that the value 20 minus 10 will be 10. So to do that, we're going to go to our auto depreciation again, and we'll just do another journal entry, this time as of 02/28/20, February 28, 2020. And we're going to increase this, decrease it by 4,000, which is, it's really an increase. It's kind of I think that's backwards the way QuickBooks did that, but in any case. And then the other side is going to go to depreciation and enter that. So now it's at 10,000 on the negative total because it's a contra asset account. And then if we go to the balance sheet, we got the 10,000. The 20,000 minus the 10. We bought it for 20. We think it's gone down by 10, so the value then is 20 minus 10 or 10. And if we look at the other side then on the profit and loss, we now have the 10,000 for the 2 time periods. So if we double click on that, there's the 10, the 6, and then the 4. So this would show us the activity, just the activity, and it's down here because it's not happening monthly. And it's not something we're doing periodically, and it's not a cash basis item. Now, if this is still distracting, this might be distracting for net income. We might be using this other income for some other reason. Under this method, we would be concentrating on the net income and then doing this on the other, this would be other stuff that we can record here that might be useful for the income statement side, but may distort our decisions. If we don't want this down here at all, we could just write this other side off to equity and just put it into the equity side. So let's see what that would look like. So if we go to this accumulated depreciation, I'm just going to change this second account. Instead of depreciation expense, just put it to equity. And that means I'm just writing it down to equity and just kind of bypassing the income statement. And we'll say yes, yes. And we'll do the same thing here. We'll just take it to equity and just bypass the income statement. And by doing that, now if I go to the profit and loss, we don't have that there, which again, it might just be more confusing than anything else. So we might want to just say, hey, I'm just going to put it to the equity. It's one option we can have. And then if we go back to the balance sheet, we're going to still see this amount is correct. And then in the equity side, we've now netted it out into equity. So if I double click on that and we look at the detail from 1.9, we've got, the auto adjustments that we've made to the equity side. Here's the split. I'm going to close this back out. If we wanted more detail and we're worried about this equity side not showing what we did, we could break it out in a similar fashion as we did with the home loan, making another equity account called Equity Automobiles, which would just break it out in the equity section, telling us this is what we wrote down the auto. We bought it for what we bought it for. We wrote it down by this amount. So that's another method we could use related to the automobiles. Now the liabilities, same thing. We're just going to do the same thing we did before, just put the liabilities on the books. So we put the auto on the books now at $10,000, increasing the equity. If we had a related loan, we'd want to add the loan as well. So we'd go to the lists chart of accounts, and then we're just going to go to account new. I'm going to make this a loan account and continue. And I'm going to call it loan auto. And then if we had multiple auto loans, we might want an account number or the company name. We're not going to enter the beginning balance here, but instead enter it into the register. Save and close. Double click on that account to get to the register for it. Change the date to 12/31/2019, the day before the time period we're working on. And the loan amount, we're going to say $6,000 as of that time period. So we're going to say that this is an increase of $6,000. Other side just going to equity. So we're going to go drop down. Other side's going to go to the owner's equity. And enter. Okay. There we have it. Now if we go to the balance sheet then, now we've got the loan, the auto on the books, and the loan on the books as a liability. And then, of course, the difference between those two are in equity. So the automobile increased the owner's equity by a net of $10,000, and then the loan here is going to decrease equity by the $6,000, and that will put us in the net equity where we should be. That's the home loan. This is the equity. And so I'm going to change this to 19. So now we have the 6,000 loan, and we have the accumulated depreciation and the auto. So the auto minus the 6 and the 4 is the 10,000. We put the loan on the books, and then the 6,000 for the loan. So once again, the auto went on the books for 10,000 minus the accumulated depreciation of the 6 and 4, and then we have the loan of the 6,000. So the net of those is the net increase. And remember what the equity is. If I close this back out, it represents assets, what we have, minus liabilities, what we owe, giving us equity, our net value. This is our net worth kind of on a balance sheet side, or it is on what we've recorded in accordance with at least the balance sheet, the financial aspects of our personal accounts here. And that would make sense then that the assets went up by 10,000 and then the liabilities went up by 6,000, so the difference between the two should be netted out, 4,000 net increase in total value or equity. For more accounting information and accounting courses, visit our website at accountinginstruction.info.